Quality of accounting equation. Equality of accounting equation. Good day, viewers. Welcome once again to Web Educate. In our today's lecture, we are covering equality of accounting equation. In the previous video, that is the former video before this, on financial accounting, we also cover equality of accounting equation. Today is a second series on the equality of accounting equation. And we are also covering illustration as we covered it in the previous video. And the illustration is this. Complete the columns to show the effect of the following transactions. Equality of accounting equation is the asset and liability of assets of a company is equal to liability plus its capital, that is owner's equity. Asset is equal to capital plus liability, that is A is equal to L plus C. A is equal to L plus C, that is asset is equal to liability plus capital, or A is equal to is C, it's the same thing, is equal to C plus L, or A is equal to E plus L. E is the same thing as what? As equity or capital. A is equal to liability plus capital, or asset is equal to liability plus capital, or asset is equal to capital plus liability, or asset is equal to equity plus liability. Equity and capital are the same thing. They are the same thing. There are two words that mean the same thing. So companies total asset is equal to equity plus liability. That is the accounting equation. That is the balance sheet equation. Today also we are covering illustration on equality of accounting equation. So we have a small illustration here to cover. The question says, complete the columns to show the effect of the following transactions. To show the effect of the following transactions. Effects of the following transactions. Effect upon asset, effect upon liability, effect upon capital. So this is equality of accounting equation. So we now have the illustration as we pay a creditor £70 in cash. For corporate purposes, the illustration is taken from Frank Wooter's book, Business Accounting 1. That is Frank Wooter's book. So we pay a creditor £70 in cash. And what is that? Asset, liability, or capital. When we pay a creditor, the creditor in our former video is what? Is liabilities. And all these are found in the balance sheet, or I call it statement of financial position. Creditor and cash. These are the two classes that the effect is having, that the transaction is having effect upon. It is creditor and cash. Creditor and cash. We pay creditor. And what is that? Creditor is what? Is liability. That's when you pay creditor. What is the effect? That is liability as what? As reduced. minus, let me just use minus sign, minus, that means liability as what has reduced. Then whatever cash, we pay a creditor £70 in cash. That means cash also what has reduced. Asset of cash has reduced. Minus cash. So the effect upon it is that asset of cash has reduced, and the liability that we are owing them also has reduced. We pay. We are paid. The one we part of the liability that we are owing, we are paid out of it. So that liability has reduced, asset of cash has also reduced. Number 2, bought fixtures £200 paying by check. Bought fixtures. When we buy fixtures, assuming you didn't have fixture before, when we buy it as what? It has increased. Paying by check. Where do we pay? We pay from what? From check, and that is bank. The money that we have in the bank has what? Has reduced. That means 2 of them are what? Are asset. Fixture is what? Is an asset. Check, that is bank, is what? Is also an asset. It's an asset. All these are what? Are found in what? In the statement of financial position. Features is what? That means features plus features plus features. From where do we get money to buy? From what? From bank. That means the money we have in bank was as, and what is the money in bank? And how is it classified? It is classified as asset. That means bank has reduced minus bank. That means the effect there is upon what? Asset. The effect upon these questions, what is on the asset? The transaction there is upon what? The asset. Both of them is what? Is the asset. Bought goods on credit, £275. Bought goods on credit, £275. What do we buy? Goods. What is that? How does it classify? It's what? Is an asset. Goods. That's under balance sheet. We have what? The fixed asset and the current asset. Fixed asset is now called non-current asset. Then you have current asset. So bought goods. Goods is what? Is under current asset, like I said in our previous video. You have under current asset, you have inventory, or you call it stock. You have receivable, or call it debtors. You have a bank, you have a cash, and others. But for simplicity's sake, let's take it as inventory, receivables, bank, and cash. If you have a prepayment or advance, it's called, they are still under current asset. Then what do you have here? Bought goods. Goods what? That means goods has increased because you buy goods and we are bringing it into our warehouse, and to join the stock that we have in the warehouse. That means bought goods. That means goods has increased plus stock. Then on credit, that means the liability has increased. We did not pay, we bought more. We have not paid them on credit. That means plus creditor. So the effect here is upon what? Asset and liability. Equality of what? Of asset and equality of a accounting equation. Then you have the proprietor introduces another £500 cash into the firm. Introduces another £500 into the firm. Cash into the firm. The proprietor Whenever the proprietor brings money into the business, that means he's introducing what? Capital. Assuming he did not have capital before, that means capital has what? Has increased, that is plus capital. Then what did the proprietor introduce? He introduced what? Cash. How does cash classify in the statement of financial position? It is classified as what? As an asset. That means plus cash. Plus cash. Plus cash. And what's the classification of another one there? That is the capital. Plus capital. Plus capital. The effect there is upon what? Asset and capital, or equity. Capital is also called equity, owner's equity, or net worth, owner's net worth. Next, J. Walker lends the firm £200 in cash. J. Walker lends the firm £200 in cash. When outsider lends the business money, that is called loan. Loan, that is loan from J. Walker. Loan, lend money, that is loan. Give loan to the what? To the firm. What type of loan? That is a cash. That is cash. So that means cash has what? Cash has increased. Plus cash. Then what is it? Loan is under what? Creditor. Under liability, you have a short-term liability and you have long-term liabilities. And long-term liability what? Is loan. That means it's under what? Liability. That means loan has increased. Plus loan. Plus loan. That is from J. Walker. The effects upon what? So upon liability and asset. J. Walker lends the firm £200 in cash. J. Walker lends the firm £200 in cash. Let me write this. From J. Walker. From J. Walker. So the effects upon what? Upon liability and asset. Next, a debtor pays us 500. A debtor pays us £50 by check. A debtor. How does debtor classify under? That is under current asset. That is a debtor. Pay us. That means asset of a debtor that was increased before has now what? Reduced. Where he was owing us, but he has paid. That means reducing. That is minus debtor, or call it receivable, minus debtor. Then a debtor pay us. He pay us in check. That means when we receive it, it's now the asset of bank as what? Has increased. That means plus bank. And you have it like that. And what do we have again? We return goods costing £60 to a supplier whose bills we had not paid. Whose bills we had not paid. We return goods. What do we return? Goods. That means the asset of stock as what? Has reduced. Goods is an asset. That is, goods what? Is an asset. That means it has reduced. Goods that we have in the asset before, it has what? It has reduced. Goods has what? Has reduced. Minus stock. And goods is classified as what? As stock. We return goods to who? To a supplier. Who is a supplier? That is what? Our suppliers are the creditors, those that give us goods that we must pay within this period of a year. That is supplier. That is, we return goods. That means we return goods costing £60 to a supplier. What is happening now? That means the stock look at that. See, we return goods costing £60 to a supplier whose bill we had not paid. That means when we first of all receive the goods, our credit has increased. Then when we now return, it has what? It has reduced because we have no money to pay this 60. We cannot pay the supplier this £60,000 anymore because we have returned it. That means it's like we have paid, because that means minus creditor. It's like we have paid that creditor because we have returned it. So it's no more in our custody. It's like we have paid. So minus stock minus creditor. And that is the end. This is the end of today's illustration. If you have been finding the course interesting, you have enjoyed, you have derived some values from this small illustration, and you have not subscribed to our channel, please subscribe to the channel by pressing the red button to show that you love our video, you love the lecture, and that will help us to produce more in the future. And whenever I produce more of this in the future, YouTube will be able to notify you, and we also be able to cover more people all over the world with our lecture, because it will help us to cover more people all over, to cover more students, and to help us to produce more of this. So continue to subscribe to our channel. As you do so, God bless you. See you in the next video.